Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. And 6 years have gone by, and we've been doing this, and I'm hoping to make it to 7. But I got to tell you, there's a lot of people who have kind of gone by the wayside in multifamily. They've either lost a lot of money in investing, or they were capital raisers and their investors lost a bunch of money, or they're operators and they put bad debt on it, not because they thought anything differently, but because of the interest rate. So as a lender at Old Capital, we're seeing this on a daily basis. The struggle is real. So if you're looking at a deal right now and you need to find out how much money can my lender bring? I'd love the opportunity. All right. So we're going to need your T12, your rent roll, the offering memorandum, and your underwriting. And we always like to go to agency first and foremost. But if that doesn't work, we can go to Bridge and we can go to Bank and we can go to CMBS, Lifeco if it makes sense. So we'll turn those deals, especially on the agency side, about 48 hours. So things have been more challenging, as you're going to hear tonight from probably Gary, who's in the audience tonight. He just closed 2 loans up in Syracuse, and I gotta tell you, I am excited about Syracuse. Syracuse is on fire. We've seen it on a lot of publications recently, how strong of a market it is. So, we're gonna kick that off in just a minute. Cody Davis is here. This is his 3rd time. I've known him for, well, gosh, 4 or 5. I gotta go back. Here, I want you to meet Cody Davis, the real estate phenom who dove in first at 19, and within just a few short years, built a portfolio of over 200 plus rental units across Washington, driven by lessons from Rich Dad Poor Dad. Cody dropped out of college, got licensed as a real estate agent, and mastered creative structures like seller financing to begin acquiring multifamily properties with zero money down. Wow. At 24, he was sitting on a $25 million portfolio, putting in nearly 300,000. It was pulling in $300,000 a month in gross revenue, and even purchased a waterfront resort on Hood Canal using the same buyer seller financing strategies. So Cody's mantra is deal, debt, equity. Finding the right property, structure smart financing, then leverage equity to grow. Today, Cody is sought as a very sought after speaker, sharing his blueprint on platforms like Bigger Pockets, Die Hard Entrepreneur, and more, like Zoom at 8. He has empowered thousands to overcome financial obstacles and build generational wealth the unconventional way. Let's welcome Cody to Zoom at 8 and understand how he turned bold ambition and creative funding into a nationwide real estate empire. Welcome again, Cody Davis. How are you?
That's quite the intro.
It's
Wow.
all true, man. Are you still okay? So are you still 24 or did you go into 25 yet?
Turned 25. Seems like every year that number goes up.
Oh my gosh. I'm trying to stop mine. 25, I have a 25-year-old son, is not doing real estate. In fact, my kids said I never want to get into real estate because I sat in the car for 3 hours. You told me I was going to be here for 20 minutes and we're still here 3 hours later. So, unfortunately, Cody, I don't think my kids are as excited about real estate as you are. So, I'm excited for the people in the room who haven't met you, but also for those who have met you before, who are going to be listening to this on YouTube. We need your update. I know you've got a lot going on, but let's start at the very beginning. You are
Very
19 years
beginning.
old. The very beginning, isn't there? Let's start at the very beginning. Um, Cody, you are come from a small family, right? Mom and
Mhm.
you and a sister, maybe?
Yeah, well, my parents split up when I was 8. So that
Yeah.
was in 2008. If I ever forget my age when I'm older, I just have to know what year it is. But yeah, so split household, grew up with my sister, and went back and forth between my mom and my dad. Went through high school. I went to college for about a semester. It was either a semester or 2 quarters, however that worked. But went there, eventually got my real estate license and dropped out of college. I was the first person in my family to not go through college all the way. So it's
Mhm.
backwards from some people's stories. I didn't do very well as a real estate agent,
I didn't know
but
that.
I was, well, it took 6 months to sell my first deal and I made like 3,200 bucks or something around there. So the monetization wasn't quite there. But shortly after, I sold a mobile home, I sold a house, and then I did the next logical thing in that progression and bought a 12-plex. So I think I sold 3 deals as a real estate agent, and I was looking around and I saw there was this one broker who was making a lot of money. His first deal, the commission was over 100,000. He
Wow.
was selling commercial multifamily, not like what some people here are buying, but 20 units made up of 5 side-by-side fourplexes, and he was getting a really big commission. And I asked him how he's making so much money, and he was putting together these deals with seller financing. He had a package of 22 units in a place called Moses Lake, which is where I live now, and built my portfolio. But I started to learn about seller financing in that office, and read some books like Deals on Wheels by Lonnie Scruggs. I listened to an audio disc on buying money low to no money down with Carlton Sheets. I used to plug that into my Miata while I was driving over the pass. So it was a 3 hour drive to go to Moses Lake to look at property. And I looked up owner financing on the MLS and there was this 12-plex. I ended up buying that without any capital out of my own pocket, without syndicating. The seller held a contract and I found I had an act for talking with people. And so I found another 12-plex and found it on Google Maps. And so I talked with that owner. They sold me a 12-plex in Moses that put me at 24 units. Shortly thereafter, I bought a six-plex from that owner and 30 units by March of 2021. All seller finance, no bank loans, no partners, and scaled from there. So since then, bought a couple hundred rentals. I flipped 100 of them last year, used
Wow.
that to pay down some debts, and been upgrading into newer complexes. So I just bought my first new construction seller financed complex in January this year. Bought out my partners. So I own a 39 unit by myself, a 27 unit by myself, and continuing to scale up that side of the portfolio.
What are you finding today in these deals? Are you finding sellers excited to do seller financing? How do you, I know you have a strategy in talking to these owners. Maybe you could walk us through that and then discuss what are you finding today and the excitement for seller finance.
Sure. Well, the ideology was you structure your deal first, then your debt, then your equity. But when I was actually finding deals, what I did is I found it on Google Maps. It wasn't some of my deals were on the MLS, about half of them. But the other half, I just found big roofs on Google Maps. And the idea was that the bigger roofs are more likely to be multifamily than single family. That was the only thought that went into that. And it ended up being true. And so I'd call them up and meet with them as an owner, not a seller, try and learn how they built their portfolio, grab coffee, and they taught me some of the ways they structured deals. So I learned about seller finance first and seller finance second, where an owner owns a property in cash and they're okay with a 4% note for maybe 80% of the purchase, and then they'll finance the other 20 in second at 12. That way I don't have to come up with any capital. I don't have to raise hard money from an investor. I'm just paying that seller a higher rate on a portion of their deal. I learned about equity participation agreements and different strategies that aren't really on the internet a whole lot, by viewing these people as owners rather than sellers. And so I wasn't trying to buy their stuff. I was just trying to learn how they got where they got. And in the process, I learned a lot of cool strategies and built a lot of trust. And they sold me a lot of their buildings.
Wow, amazing. So the ones that you have, the 12, the 6, and then the total of 30, those came from all the same seller. Is that right?
The first 12 plex was on the MLS, and then the second 12 and the six came from the 12 and the six were the same person, but it was not the
Okay,
same as the MLS deal. Yeah.
got it. Okay. And so in today's market, when a seller can get paid on interest at 6%, are you having to get to 6% on any of these deals for the
Not
first?
not necessarily. So it depends what they want. Like a lot of these people aren't doing it for the income. They have enough income or they have enough money. So what they're trying to do is set up a legacy for their kids. So something I found to get lower interest rates is to do, let's say it's nominal rate of 4% interest, and I do interest only. We can talk about that later, but
Yeah.
factor rate, factor rate versus cap rate, and why interest rate is irrelevant. And factor rate is what matters. Well, we do a 4% interest only loan, and there's an appreciation clause that kicks in at the balloon, or instead of a balloon, a review period. So if we do a 10-year term, they're going to agree to give me 4% interest, but they're going to get to share 25% of the net appreciation of the asset. And what that's for is to benefit their kids or their heirs with some equity
Mm.
bump in the future rather than benefit the seller with a higher interest rate. Because if they own these properties in cash, they don't need more disposal income typically. So what they're trying to do is set it up for their kids. So what I do is I structure it with an appreciation clause where the net appreciation, if it goes from 1 million to net sales price of 2 million, they would get a $250,000 lump sum when I refinance or sell it, which either the bank's paying for or the new buyer's paying for, and that would go to the kids. And that's the way I get in with lower interest rates today.
Wow. So have you refinanced any of these deals or have you sold, you said you sold 100 of them, and is that the structure that you provided these sellers with?
Not on those, but I've sold some just conventionally. I sold some to friends. Like I sold a 1952 build sixplex and 1031 that into a seller financed 7 unit townhome site that was built in 2021. So I've been upgrading there. I haven't had to offer the appreciation clause in a whole
Oh,
lot, but it has been a solution
yeah.
to make the numbers work. Because if you get 10 years of 4IO, there's going to be some appreciation over that 10-year span as long as you're not buying in a dead market or a market that just happens to completely flip and go belly up. Like that can happen, but it's unlikely. So I'm just trying to get the interest rate low enough on deals if they're not flexible of coming down. That is a way I've gotten around it.
So these deals, well, they're all paid off. I would think that they have a requirement of some CapEx. How do you fund the CapEx on these deals?
Well, I fund the capex out of cash flow, which isn't
Aha,
the most it's not the most ideal structure.
sure.
So if there's a lot of capex that has to be done, something that I have done in the past is reduced payment for 6 months.
Oh, okay.
So maybe the payment, like when I bought my 38 plex and eventually turned into a 39, it didn't make a whole lot of money every month. So instead of a $10,000 fixed payment, which is what they wanted, we did $7,000 a month for the first 6 months. Something else that I've done, because I've brokered deals to clients. I just sold one. They bought it 1% down, 6 months, no payments. They're using the no payment period to roll back into the project.
That makes
But
sense.
if you're a syndicator and you have the money, you can do that and it just is gravy. But for me, I was doing it out of necessity because I don't have any partners on a lot of these deals. And so I didn't want to go into massive consumer debt just to fund these to the best
Yeah.
of my ability. So I tried to structure the note where I'd have reduced or no payment for a period of time and then operate it as if I had no debt because I wouldn't have any payments and take that money and shovel it into the asset.
Paula, you've got a question.
Yes. Hi, Cody. Thank you for your presentation. We appreciate your expertise. And I put my question in the chat. Who did you learn the legacy clause from? That's the first thing. And then I want to make sure I got the parameters of your loan. 4% interest only loan, appreciation after 10 years when sold, paid to children of the previous seller. Did I get all that right?
Right. So well, that's the gist, but the that is a strategy or it's a tool you can use, but those numbers can all flex. My whole thing, the reason I figured this out is there's a guy named Gary who owns a bunch of stuff here in Moses, and he said, I sure wish there was a way to get a little bit of income now, but give the equity to the kids and give them some of the benefit. And his whole thing wasn't just the money. He wanted to feel involved. So I took those pieces and I put it into Chat GPT and I said, I have a seller who owns a ton of property, a super smart guy. He's worked really hard for a long time, bought a lot of rentals, paid him off. He loves to play the game. He's going to continue to play the game. He doesn't want a whole bunch of income or interest right now. He just wants his kids to benefit and he wants to still feel involved while he's alive. I put that into Chat GPT and asked for what it should give me. And it said, well, you could do an appreciation clause, whereas they're not a partner, they're a lender, but they get to benefit from the net appreciation of the property. So as you improve it, they're going to still feel like they're involved and they're leaving a legacy for their kids. So I took all the inputs I could from my meetings with owners and I plugged it into a tool, the AI tool, ChatGPT, and that's what it kicked out.
That's amazing.
So was there significance in the fact that these sellers with the high earnings already, that they wanted to feel like they were participating? Was there significance of that? Was that something
Yeah,
that personally
for
wanted
him. Hmm.
for one person or for many?
For multiple people, because they've spent a lot of these people have spent their whole life getting to where they're at. And so he doesn't just want to not own property. So he wants to still feel involved. And if he can drive the property and be like, wow, this is really coming along, I'm going to get to benefit from this, and my kids are going to get to benefit from this in long term. Because if you think about it, while they don't own it at that point, they're backing whoever buys the deal. So I bought a deal, it's like a waterfront 15 unit from that guy, and it's not the nicest of properties, but he financed 1.2 million. So he's backing me 1.2 million on that deal, even though he's not a partner. So for him to still feel involved and feel like his legacy is going to get to benefit from me going in and improving it, him financially backing me is going to benefit his kids, and he likes that.
Do you
Well,
find that?
the lender, the partner, though? I mean, you say he's not the partner, but he's your lender.
Well,
Yeah.
yeah, every lender is a partner in a deal,
Yeah.
but I own 100% of the equity. I I don't have equity partners, and so he is a lien against title. He'll get to benefit in the fact that I pay every month and that his kids will get an equity bump in the future. But day-to-day operations, when I go to refinance, it's just me on the title. I don't have any other participants. There's just no bank involved. I'm working with an individual.
that make sense, Paula?
Yes,
If not, I can.
no, I love it. It's just that I just feel spiritually that there's a reason that I mean, after all, they built the empire. They didn't probably have a lot of time with their children. I think it's probably the way that they show their love for their children in that way.
Yeah.
Yeah, that's
Make it maybe a little bit easier for their kids. I love it. Why
yes,
do
I
they
love
need
it
all the
too.
money?
Sorry to
Yeah.
interrupt you earlier, Julie. Go ahead. I'm
Yeah,
sorry.
no worries. So, Cody, these conversations, you say, I'm gonna sit down, we're gonna have coffee, you're gonna tell me how you did it. Are the amount of times that you're sitting down with somebody and I mean, you're just a likable guy, you're a good-looking kid, you know, what are all of them open to seller financing? Do you find that they're, like 1 in 10? What is your success rate on that?
Well, it's not about the getting them to seller finance. I'm looking for the best way to play the game because there's definitely some people would argue there's not a best way to play the game, but there's always going to be a more efficient way to play the game. And so what I've tried to do is get the best pieces from people's stories, what they've done, and learn from the worst, but try and use the best pieces from multiple people's stories and make a more efficient path. So more so than saying I'm trying to buy your stuff. Like I bought property from people that wasn't seller finance.
Mm,
I structured a deal. It was a development site, 6 units. It's got room to put up 10 townhomes. Instead of seller financing, I got a hard money first with a hard money second. I didn't have to further encumber any other property. They believed in the vision. It was a hard money company out of Bellevue area, so like Seattle.
mhm.
And I got a first, and then I got a hard money second. I didn't buy it with seller financing. It definitely didn't cash flow 100% hard money. I'll say that. But I more than doubled the rent roll, repositioned the debt. Like it was a calculated game, and within 2 years, got it repositioned with new debt. Now it's 10-year fix at I think it's 7% interest. My payment's 26.65, and it brings in 55.50 and change. So it's not
You're
like it's a
living
home
off that
run, but
cash.
but but it has some net cash flow on it,
Mhm.
and I bought it zero money down.
Amazing. All right. So, do you get a sense of the time frame that it takes you? You look at an asset, you go, "Okay, I wanna build a relationship with that guy." You meet, you kind of figure out how you're thinking, what this could look like, and then the time that you have to buy it, can, do the whole transaction. Do you get a sense of what that is? I want people to understand that this is a long game. You've done an amazing amount of success in a short amount of time, but you've also been putting down these seeds for quite some time, and you've been able to, build some very strong relationships.
Yeah, well, it is a long game, and so if I buy something from someone, I'm going to do a project on the building, send them photos, let them know what I did. I try and further the relationship. And the way I got started on my first deal, I'll give you an example. I bought from the guy. It was listed on the MLS. The guy who sold it to me owned one other building in a small town nearby. He financed 90%. I got a 12% interest only private money loan. The brokerage I worked at, some one of the clients lent me the money. And this was when rates were 3. So I was borrowing at 12.
Mm,
So like, it doesn't sound like a lot now, but it was a lot then.
mhm,
And so I ended up buying that deal, zero money down because it was 10% of the purchase was hard money in second, and then 90% from the seller. I kept in touch with the seller. I kept sending him photos of what I was doing. When I would turn a unit, I'd be painting, cleaning it up myself. I learned what not to do when resetting a toilet. And it's just, there was a lot of things I did wrong, but I kept in touch. And when that hard money loan. I call it hard money. It was private, but it was from an investor that lent in second. Shortly after that was coming, like right around when that was coming due, I called up the seller and he actually lent me the money to pay that off.
Wow.
I had been paying interest for a couple of years. So I had 100% seller financing, but I went back to the seller and got that loan later. So it was almost like a cash out seller refinance,
Yeah.
but kept the first loan in place and building that relationship up. It didn't happen right away, but just keeping in touch, talking with them, letting them know what I was working on, that came in handy.
Certainly. Now, a lot of people say none of these deals work. How are you getting deals working with a 12% or hard money is, today is hard. But what is
Mhm.
what do you think is the best structure for somebody looking at deals today?
Yeah,
What do
so
you
there's a
what do you
magical
what's your
formula.
input?
Well, I did a lot of research on this, how to quantify how to make any deal work. And I figured it out a few years ago. Well, I had COVID, and so I was on a computer, and I was just at home for a couple weeks because I've never really been traditionally employed. So when I was feeling sick, I just stayed at home on my computer,
Mm.
and I figured out the relationship between debt and net operating income and how to really calculate it. And I came to this conclusion of what's called a factor rate. So everybody seems to know what an interest rate is. Does anybody here know what a factor rate is? All right.
I don't think so.
So factor rate is something that every mortgage calculator has built into it, but most mortgage lenders don't know what it is. And so what it means is it's your true cost of capital expressed as a percentage. If you go look at buying a deal and you find a cap rate, and your cap rate's your cash on cash return if you pay cash. So what you could say in simpler terms is it's your net dividend expressed as a percentage, right? If you buy $1 million deal on a six cap, if you paid cash, your net dividend with cash flow would be 6%. So what I tried to quantify on Excel when I was sick, what's my net cost? Because you have an interest rate, but if it's amortized, you have to account for the debt paid out. And so I figured if there was an equation to get the exact cost of capital expressed as a percentage, I could just see which one was bigger. Either my cap rate's bigger or my cost of capital is bigger. And your cost of capital, again, is just, it's a factor rate. And the way you find out what that is you take your annual principal and interest and you divide it by the loan amount. So if you want to just simplify it, principal plus interest times 12 divided by whatever you borrow. And so rounding to the nearest decimal, the factor rate on a 6% 30-year AM is 7.19. Meaning if you borrow $1 million, 6% interest, 30-year AM, your mortgage is going to cost you 71,900 and change. And that factor rate does not change. It's tied to the interest rate and the amortization. So if you buy any deal, 6% interest, 30-year AM, if you want to break even, you have to buy at a 7.19 cap rate. If you want to make positive spread, you have to buy at a 7.2 or better. If you make negative spread, you buy under 7.19 cap rate. That's it. If you borrow 7% interest, 30-year AM, you're going to find your factor rate is about 8. So $1 million loan is going to cost you about 80 grand a year. So you'd have to buy above an 8 cap. And of course, that number will get higher and higher and higher if you do a 25-year AM, 20-year AM, because you're paying more principal. But it's just your principal and interest on an annual basis divided by the loan amount. And once you figure out what that number is, you can test it on any loan. You never have to figure it out again. So what I did is I wrote it all on a piece of paper, eventually memorized it. 4% interest on a 30-year AM is about 5.72. So if you get 4% debt, 30-year AM, you got to buy a 5.72 cap or better. which is why everyone could make every deal work way back when, because you could get those cap rates. And so that's how you make any deal work with high leverage, because I was buying everything very highly leveraged. So I just had to make sure the cap rate was higher than the factor rate. I'd make positive margin on every dollar I borrowed. And because I borrowed so much money, I had a lot of margin, and it allowed me to get into deals with no money.
Wow. That, my head's going to explode. Anybody else? Oh my goodness. What questions do you guys have? Hubert.
Yeah, I mean, amazing, but I'm gonna need to read that multiple times to like understand it. Do you have a website, a booklet, a book, or whatever to explain how the I believe you called it the factor rate or whatever?
Yeah.
I gotta put together another video on it. I used to own a company, which I don't anymore. I sold out of it, but I think there's still a video on it. So let me find. I'll try and find that, and if not, I'll make another video and send it to
And
Julie.
you could send it to me and I can put it in the email that goes out on Fridays. I'm going to make a short video of that, and that will go out what you just said. That'll go out in socials. I think that will be very valuable to you guys. But then also you'll have to listen to it again on the long video because I think that's worth a ton of value. My God, Cody, that's incredible. So
The magic.
it's magic. And you just kind of put it out there for our heads to explode. Paula, you got a question?
Yeah. So Cody, that formula, first of all, works only as long as debt is money, right? And then second of all, if you have a deal that you're questioning, okay, is that really going to work? You could use this formula and then apply it to what their cap rate is, right? And then you could see, yes, is it projected to work or not taking into account all the other things that the deal holds, like scale and vertical integration of property management and other work related costs.
Operation costs.
Yeah, operational costs. I just wanted to see if that would work to decipher a deal, sniff out a deal, because we're looking at a few deals like that right now, and it works for the fund managers, and I don't know that it always works for the investors. And that's
Well,
what
so that
I'm trying to do the acid test, the stress test on it, with what their assumptions are on where the cap rates are upon exit.
yeah, well, to answer your question about all the operational expenses, the math is the math, and math doesn't lie. People do. So to be fair, this equation will never fail you if you have good inputs. But if you do bad due diligence and you underwrite to the wrong NOI, all of a sudden your cap rate may look like it's higher than your factor rate, but it's not, because you're not accounting for certain expenses. The thing you got to make sure you're doing is due diligence to understand this is a reasonable, conservative net income. And based on that, I can pay X amount to where my dividend expressed as a percentage is higher than my cost of capital expressed as a percentage. And there's more equations that I don't know how deep we're going to go today, but I can show you how this all works together with debt coverage ratios, debt yield for lender protection. Like there it goes down the rabbit hole, and we can do that.
You love
But
it. You love the rabbit hole.
me too. That's how I figured all this stuff out.
Well,
Okay, let's do it.
And what they said on past deals as to what is possible with that NOI may not be true for what is the future in NOI. And they say for past deals they did great things. Well, that's past deals.
Mhm.
We're looking up some banking challenges in the next three years that are substantial, I think. And so, I think I've seen some of the banks, Julie, close your ears, that are making sweetheart deals with the prices, saying, okay, I'll as long as you purchase a property for this level higher than what it's valued, enough to pay off the banking loan, then what we'll do is we'll promise you the option in 3 to 5 years to refinance if you do this, this, and this, you know, regardless of whether you can raise the rents for NOI. But I'm just saying that that may not be true based on the market and liquidity. So I'm just saying that, you know, they say a lot of things about their past deals and how much the market they own.
Well, let's see, Cody, let's walk through that. Have you seen it change? Those numbers are not mathing in today's market with the higher interest rate.
Well, so it still works,
Mhm.
but you might have to figure out a way to bring down your total cost of capital, because we can do this with 2 loans. Doesn't have to be with just one, your total principal and interest divided by your loan amount. So I just bought a deal. I got 75% bank financing, a 15% seller second, and there are commercial lenders who will allow that on $5 million deals, $10 million deals, $500,000 deals. And so it allowed me to buy this purchase with 10% down and lower my total cost of capital. I didn't necessarily get a much better rate, but for that 15% seller second, it was interest only. And that can lower your factor rate a lot, because the factor rate on an IO loan is just the interest rate, because the equation's principal and interest. So there's some creative ways to make deals work. I mean, I've seen projects where you go buy a building for 5 million, you get a bank loan for 3 million of the 5 at 7.25%, but the seller finances $1 million at 3% interest only. That completely brings down your total cost of capital as far as the debt stack goes, and that can get it below the cap rate you're paying. Lots of ways to spin it, even with today's interest rates.
Hey, Cody, I've got a question for you. Just
Mhm.
trying to think about how this might work. You know, as John and I were talking about the way that we raise capital through syndication. Um, we go in, but we go in with capital. Like, yeah, you can get the deal, but then you're just running it. We actually, when we buy these properties, need a significant amount of cash to be able to improve them, right? Our plan is to go in and significantly improve these properties. We need cash, capital. So I'm just questioning, where does that come from? Like, I mean, I'm not having any issue in our neck of the woods, funding deals, right? We're cash flowing, we're finding properties, the debt's not a problem. Can we do it without partners? Could we, do the seller financing part and and get the thing without having to raise capital? That's interesting. Love to be able to do more of that for sure. But where's that capital come from? You can't just, the way we operate it is we have a business plan. We go in, we've got to, in order to increase the NOI, you've got to have a business plan, and that generally, improve the properties. We're putting in, $10,000 to $15,000 per unit, possibly exterior renovations. See where I'm going, right? That's kind of my question. Is I'm wondering where
But
that comes from.
yeah, if you got to bring in a partner for that, absolutely. What I would encourage folks to do, though, if you want to own stuff by yourself, you're probably not going to start owning it by yourself. But probably not, like, unless you get super creative, which you don't have to do. But what I would encourage you to do, you're already raising money. Let's say you buy a $5 million deal and you're putting 20% down, like you mentioned earlier. So you're coming in with $1 million. And 48 units, you spend 10 grand a unit, it's another $500,000 plus reserves. So you're raising maybe $1.5 million to $1.7 million, somewhere in there. If you were to get the seller to finance that 20% down, you would have to come in with 600,000, 700,000. And if you're going to have the same upside as if you put 20% down, what happened to your IRR, right? You get a much higher return for your investors with less money down and the same amount of physical upside. And when you go and do the next deal, you can do it by yourself. You could start with a partner on one, go get a huge win, and then take the money and do the same strategy on the next deal by yourself. A question that I'm going to propose, anybody can answer it before we go into the math terms, because it's going to go into more of what you just asked. If I buy a building for 5 million and I sell it for 10 net of sales fees, what's my ROI?
2x.
I'll tell you when you get the right answer. That was not the right answer.
100%?
Nope.
1?
Nope. Anybody got it? You buy it for 5, you
1,000.
sell it for 10. Nope.
How much did you put down?
There we go.
100%.
Well, so here's the thing. Your return is 100% subject to how much money you put in the deal. Now, I'm not just talking about you as an individual. If you're bringing in a bunch of partners, you have to account for that. So how do you fund the renovations? Well, it depends how we structure the first portion of the money. Because if you can get 100% debt that cash flows for the purchase, that's going to dictate how you decide to structure the renovations on the back end. It is 100% dependent, because if I buy that $5 million deal and I put 5 million down, I get 100% return. I double my money. If I sell it for 10. If I put $1 million down, I turn $1 million into 6. It's a great return. If I find a way to get in with $500,000 of total capital, I get 100% debt for the purchase and it cash flows. And then I bring in a partner for 500 grand to do the renovations like we just talked about on that example. I turn 500 grand into 5 million. There's so many different ways to structure it. But the reason I bring this up, Gary, is because you may not want to bring in a partner if you have 1,000x return. You might go figure out how to encumber another property you own just so you can do it yourself because the return is so high. But if you got to go in and put $1 million, $2 million, $3 million down to buy it, and then you got to fork over another 500,000-700,000 to renovate it, I mean, that money's going to come from partners because they're probably going to accept the lower return. So it is 100% dependent on how you front the first portion of the money, which is the acquisition. With that said, I'll share my screen on something I built years ago. It has a couple slides. I'll try to keep it as simple as possible. Can everybody see this?
Yep.
All right. So I built this simple as I could to try and explain things. So your net operating income in this example just shows the impact of different cap rates. Since we're all have a little bit of experience here, we know the higher the cap rate, the lower the price, lower the cap rate, higher the price. They're inverses of each other. And this is your cash on cash return when you pay cash. It's an unlevered dividend. Equations, your net operating income divided by your price, and simple terms, it's your cash flow if you had no debt. That's the one that most people understand. The next thing, the loan factor rate. Now, there's a lot of numbers. Don't worry about all the numbers right now. Let's just go through it simply. Let's talk about the equation. It's your annual debt cost divided by your loan amount. Principal and interest times 12 divided by loan amount. And I figured we could go through this so that people could just rewatch it instead of having to take notes.
Yeah, that's great.
So that's your equation. That's going to be your equation 100% of the time. Regardless of the inputs, you can have good inputs, bad inputs. This equation will never change, which makes it very simple. And what it represents is your true cost of capital on an annual basis expressed as a percentage, and this refers to debt. We're not looking at equity, we're just looking at debt. So in an example, you buy a deal on a 7 cap, you got a $1 million purchase price. And for this example, we're going to use $1 million of debt. I'm just using round numbers. It doesn't matter what the number is. You can put as much or as little money down as you want. It will not change the math. So interest only, 6% interest. If it's amortized over 30 years, like I mentioned earlier, it's about $71,900. It's a 7.19 factor rate, and it's negative because it's a payment. If it's interest only, it's 60 grand a year. We took the interest rate multiplied by the loan amount, which means your factor rate is the interest rate. It's just interest. If we're looking at the amortized piece, you are making a negative 0.19% spread because your dividend's 7 and your cost is 7.19. So you're actually losing $1,946 on the debt. If all of a sudden we bought this at a 7.19 cap, that would magically go to 0. And it's rounded. It's like there's another decimal. So that's $46 you'd lose on the debt. If all of a sudden we went to a 8.19 cap, you'd make a 1-point spread on the debt. And so what gets interesting in this situation, is you start to figure out, if I can make a spread on this amount, I can borrow as much money as I want. If I make a 1-point spread on $100 million of debt, as long as I have a term that's in the future, I'm great. And so you can start playing with the numbers to figure out, okay, well, what if I borrow at 5%? What if I borrow at 4%? What if I borrow at 10? Do I need to be interest only or amortized? One reason IO loans are great is because your interest rate is your factor rate. So if you buy at a 7 cap, you can get a 6% IO loan and make a 1-point spread rather than lose 0.19%. And on big loans, that really adds up. So this is all really important. Before I move on, does anybody have any questions on this section? Because this is good to grasp, especially if you want to scale and use leverage.
Anybody?
If not, we're good.
Let's keep going.
I know it took me a lot of times to figure it
Yes.
out.
Can you share it? Would you be willing to do that, Cody? I'm the one that asked.
Yeah, I was about to ask the same question.
Yeah, I can share this.
I mean, anyone can build it. It just takes time.
Yeah, no, I'm not worried about that.
Time to
I mean,
spread it.
I memorized all this stuff, so I don't even use this sheet anymore. But
Thank you.
it's super
I'd love to be
helpful to have.
Yeah. Cody, why don't you send it to me and then I'll send it in the email for everybody.
Cool. All righty. Well, let's go to the debt service coverage ratio and go over the fun magic of this. So debt service coverage ratio is looking at your net dividend above and beyond your debt obligation every year. You're trying to see how much of cushion you have. So we're taking our net operating income, the cash flow you'd have if you paid cash, and dividing it over the loan payments per year. The thought process behind this is I want to have a margin. I want to have net cash flow above and beyond any obligation I'm taking on, because it doesn't matter what things cost if everyone else pays for your stuff. And everyone else in this situation is your tenants. So in an example here, you buy a building, maybe you've owned it for a long time, you've increased the net operating income, NOI is 180 grand, your loan payments are 75,000. In this case, your debt coverage ratio is 2.4. Let's say you pull out a little bit of money, your rate goes up, now your loan payments per year are 90,000. You have a 2 debt coverage ratio. Maybe we go up to 135,000. You're at a 1.333 debt coverage ratio. This matters because lenders care about it, but what it really matters is you're looking at how many months does it take me to save up an extra loan payment? Because making money is awesome. Losing money is less than not awesome. Like it's really cool to make money, but what people really don't want to do is lose money. Like if you break even, whatever. Like it sucks, but it's not losing money that you work for. So what I do is I make sure I have a path on every deal I own to get to a 1.5 debt coverage ratio within 18 months. Have to get there. I can't get there, I'm probably not buying the deal. So if my obligation, let's say it's 120 grand a year, 10 grand a month on a mortgage, whether it's principal and interest or interest only, I have to be able to get to $180,000 NOI. That's the basics of all my deals. You're not going to find a deal that I buy that I can't do that. If you can't do that, you're probably either A, buying bad deals, or B, structuring your debt wrong. Because on any deal in any market, you should be able to get here. It's just a matter of making sure that your first position debt, and if you have a second position debt, get your total borrowing cost low enough. And there's lots of ways to do that. But in this situation, whether it's 12 plex, 100 unit deal, I want to be able to get to a 1.5 debt coverage ratio. Paula?
Yes, sir. What about the risk to your business plan of reaching like 20% per year or whatever for your NOI, whatever you posit? What if you are 3 years into the deal, hoping to refi, and you realize you can't raise rents? The market is just not letting you for whatever reason, and you have to stop your rehab and reevaluate your plan. Then what?
You're definitely going to have to do that. So you're saying, okay, I can't exit, or
The market is not letting you raise your rents. The rents are negative or flat. And you may have had a plan to upgrade to a specific level of, like say a 4 or 5 star property, but say you have tech jobs adjacent, but it's not working. And your property manager is solid. So what do? That's when you have an issue with this NOI goal.
yeah, you could absolutely have an issue.
Yeah.
But what I do is I make sure I'm buying deals that conservatively can get to the 1.5 within 18 months.
Okay.
Your question you
Eight-
proposed was 3
18
years
months?
in.
Yeah, 3 years.
You were 3. So at 3-year mark, if I dip from 1.5 to 1.4 or to 1.35, I'm not SOL.
Mhm.
A lot of people are happy if they get to 1.35.
Yeah.
But all I'm saying is I want to have a conservative plan to get to 1.5 within a year and a half, because you should be able to if you're operating the property. You're not going to completely change it from class B to A or C to B in 18 months all the time, but you can definitely get the NOI up in 18 months. And so my goal is to structure a debt product, because if I borrow cheap enough money, I can definitely get here. And there's a lot of owners who are willing to finance in second position, finance against the LLC, finance against a different property to get your borrowing costs down. A lot of ways to do it. There's also ways you can structure them as equity with fixed buyouts, which lowers your net operating or your net cost on the debt. And we can talk about that too. But your objective, at least my objective as a buyer, is to make this happen so that if something goes wrong in a few years, like rent control just passed in Washington State. So there's rent control on anything older than 12 years, which is why I'm also upgrading to new properties. But if my taxes or my insurance jumps again, I just had insurance jump 400% on a building. I was at like a 1.8 coverage. That went down a little bit. But if it happened again for some reason, then maybe I dip below 1.5. But at least I had a plan to get past the 1.5 so that I have enough margin to make mistakes or to get trapped in a bad market. What you don't want to
market
do
was
is
that? The 400%. What was the insurance market that did that?
it was on. So this is the best part. I replaced the water heaters. I upgraded over half the units, all new wiring, all new electrical panels, and they took my premium on a building where I also redid a lot of the plumbing, new gutters from 4,300 to like with all the charges and everything, it's over 16 grand. It's 15.7 plus more fees. Like they have fees. It's stupid. And I'm shopping it around, but even the cheapest rate I found is over 12 grand, which is a 300% not return cost increase.
Can you tell us the market, please?
Quincy, Washington.
Oh,
So, Cody, I do have a question on your location.
Mm.
Are you going to stay in Washington? Are you thinking about doing other markets? And what is the interest in Washington with some of the challenges that that state has?
Well, I'll probably stay here. I might adventure out. I've thought about buying in more landlord-friendly states, but there's a lot of people who are unwilling to deal with the stuff here, all the rules, and it creates unique opportunities. People just want to get out, and people act like the whole universe is falling apart. I mean, there's painful parts of Washington, but at the end of the day, someone's going to own the real estate. Someone's going to get paid to own the real estate. And traditionally, the West Coast has lower cap rates, and lower cap rates appreciate more. So if I can get into a cash flowing deal with long-term fixed rate debt in a more appreciation prone, high restriction area, restrictions create opportunities for owners, then I don't see any reason to get out. I just see reasons to double down. And so that's what I've been doing. I deal with a lot of landlord tenant issues. However, I heard this from a good friend now. He wasn't a friend. I didn't know him until I did. I guess that's how it all works. But I met him on Facebook, and he owns 1,000 units in LA, and very hard landlord area. But started small, bought bigger, bought bigger, bought bigger, kept doubling down over and over and over. Where other people were getting out, he was getting in. And it created a unique opportunity. And over a long enough period of time, you could do the math. You own 1,000 units without partners in LA, and you're doing okay. So my thought process is that I can just do the same thing. A lot of people get out. It gives me opportunities because I know the math and how it works. I can get in and get my debt costs cumulatively between the bank and the seller. I can get my costs low enough to get great cash flow on deals for long periods of time and deal with a little bit of headaches along the way, more so than other people would, but make a lot of money along the way. Because you also got to remember, everything I built was worth $3,000. So I've really been able to
$3,000 you
lever in.
started with. That's it.
That's it.
Amazing. It's amazing.
You are so incredible, Cody.
You're so good. We love it so much.
Cody,
Appreciate that.
all right. Are we finished with this
Yeah.
last one here? Or
Yeah.
we've got a little bit more.
We got a little bit more, and this is
Okay.
just a gross example. Never do this, but I just wanted to demonstrate how good leverage can make anything work. You could buy a deal at a 1 cap, $100 million purchase, $1 million NOI. If you got 0.5% interest only debt for a very long period of time, you'd have a 2 debt coverage ratio. If you could sign yourself up, and this is a question I've posed to people in the past as a joke, but there's no way any deal is going to trade on a 1 cap, not in the US. So if you bought a $100 million property and they financed it 0 money down, 0.5% interest only, non-recourse for 50 years, the question is, would you do it? And some people say, no, that's stupid. But the way I'm looking at it is I get $500,000 a year of free cash flow for 0 money down for 50 years. And a lot of these seller notes are non-recourse anyway. So put the risk on the real estate, right? The price is irrelevant if you can get terms that allow you to get what you want. Because a lot of us, I mean, I don't know where I'm going to be in 50 years. I might be dead. And the older I get, the more likely that is to be true. So if you can get terms that are good enough and have security in the fact that if it goes wrong, you're not going to bankrupt your life, find a way to get your debt costs below your cap rate. As a gross example, 1% and 0.5%. But it gets the point across that you can pay anything you want and still make all these numbers work
Positive leverage.
for long periods of time.
Cody, what about words of wisdom? You made some mistakes, maybe in some partnerships. What are your words of wisdom?
Well, I've made a lot of mistakes. A lot of my mistakes came from partnering too early. So what I've done, and this is all my fault, but I get an idea and then I have the habit of just sharing it with the first person I think of. So my very first partnership, it was after the 30 units. I bought a 38 unit deal, 0 money down, And that was the first time I took on partners. So I had 3 people I met along the way, because you meet owners as you become an owner. And so it was $2 million purchase price. It was listed on the market for 13 years straight. I needed 300 grand down, which is 15%. Seller was going to finance the rest at 4% interest. It was a great pickup. I've since doubled the property value. It's worth a little bit north of 4. But when I bought it, I had the capital partners to put it together myself. And I reached out to a buddy in the office because he was relatively close to my age. He was 28 at the time, and I was 21. And everyone else in the office was 40s, 50s, 60s. So I was like, hey, I got this deal. I lined up the debt. I've got these partners. Do you want to do this with me? And we just did it together. And it was fine. Like, we made a lot of money, and we went on to buy hundreds of rentals and some other stuff. But looking back on it, I didn't need to do that. And I've done that again and again, where I come up with a cool idea and then I split it with someone. And then we all make a bunch of money. And then I'm like, I should have just done that myself. So if you can build your own business, you can do the syndication thing, do the flips, but I would try and secure your freedom outside of any other people. So if you need 10 grand a month or 15 grand a month, you can go build that business with other people and partners. But I'd also try and replicate that on the side by yourself, because the likelihood of your partnership lasting as long as you last is low. And so you get there with that person, but then get there on your own. So I partnered with that guy and I eventually bought him out. So I own that deal by myself, and I own 27 unit by myself and a new construction 7-plex by myself. I couldn't have done that all right away. And I still got the first 12-plex I ever bought turned into a 13 unit. But if you make the mistake of partnering on everything you do, I'd try and replicate that on the side, just yourself, without LPs, without co-GPs. And then to take it even further, I'd lever up the partnership deals with smart leverage to pay off your personal portfolio. So go do some value adds with partners, pull out a ton of cash, and then write a check for your debt on the personal side. Because if you own a 30 unit in cash by yourself, slap a big line of credit on it for protection, and then get the benefit of free and clear real estate.
Yeah. Are you property managing all of these yourself, or are you having them property managed?
I have a property manager. I might be firing him right now. We'll see, TBD.
Yeah.
But I used to self-manage. I self-managed my first 81 rentals. And it wasn't that it wasn't that hard. I don't know that I want to do that again. But at the same time, my rentals are a lot nicer than they used to be. So it wouldn't be as hard. Because when I
Wow.
bought everything, I bought some really nice property, and I bought some really not nice property, and like everything in between. So I self-managed some of the slums. I self-managed some really nice stuff, and luckily I don't have any slums anymore. So I'd be open to it, but probably not.
Cody, do you do any education programs? I know you were doing some in the past. Are you involved in any of that? How can
I'm not.
people, how can, in a selfish way, I want to, sit down with you and continue to pick your brain on all of this stuff so that I can be half as awesome as you. What are the things that you would recommend for people for getting as awesome as
Well,
you?
I don't do a whole lot of consulting as far as the real estate side goes. So I owned a consulting company. Talk about one of the ideas I shared with a friend early. I sold out of that. He's running the show. And that company's helped a lot of people. So that it's called Multifamily Strategy. But I also signed a non-compete. So I can't do real estate consulting anymore. So oops, 8 years till I can do that again. I do business consults, but mainly my thing is I just do a YouTube video twice a week. That's what I like to do. It's free stuff every week. Some videos are 2 minutes, some are 10. I have a couple interviews on there. interviewed a guy who's my age. He bought 800 and something apartments without partners, without syndicating, without any money over the course of 4 years. So he did
That's
what I
amazing.
did on a bigger scale. So he started buying 40 unit, 60 unit, 80 unit deals. He'd get a bank to finance 70% and have the seller finance 30 to 35% second. So he could buy it zero money down, actually get paid at close. And he wrote the notes where it cash flowed with 100+% leverage with a plan to improve the rents. And you do a couple of those deals by yourself, you get to 100 units, 200
Set.
units, 400 units. Yeah, you're done. So, I mean, he's an 8-figure dude. But he did it in 4 years. So
Wow.
he did what I did, but with bigger deals. And I post there Tuesday and Thursday. So I posted there today. It's just in real time what I'm thinking about. So I think it was about addressing your hard conversations, because I called my PM and very kindly said they suck.
Yeah. Tough.
Yep.
I don't know how to wrap this up. I got just so feel so inspired by you, and every time you come here. Anybody in the house have a question or comment? Have you two been inspired by Cody?
Yeah, I just want to say great, great meeting, great talk. It's really out of the box thinking. I love it, Cody. Thank you.
Appreciate it.
Thank you. Hubert.
Hey,
what do you got?
Cody, what's the YouTube video? Is it the YouTube channel? Is it the multifamily strategies that you're posting on?
Oh
That
no.
was well, I'm not on there anymore. So I got out of that about 2 years ago. I put my YouTube channel in the chat here. So
Okay.
it's doing Cody Things YouTube, because I am in fact Cody and I do Cody Things. That was thought. I also have doingcodythings.com. Who would have thought no one would have ever made that website? So I got that.
Oh, Cody. Cody just is engaged
Yep.
to be married. When is the wedding, Cody?
October 19th.
Coming up.
Yeah, that is coming up very soon. So that's exciting.
Wow.
And she has her own rentals too. She's got a 10-unit portfolio in Tennessee. She has started building that before we met. So that was cool.
And she's military too, guys. She's still
Yep.
in the military?
She got out. Yeah, she just got out and got her first civilian job, as she would say it, but fully remote. So she lives in Moses Lake with me. So that's fun.
Oh my goodness. Paula, what do you got?
Cody, you said you learned a lot from having partners. What are the traits that you look for now in partners? What's most important to you and why?
No
Well,
partners.
if I when I partner with someone, I have to be in the driver's seat. I've partnered with people before that wanted to be in the driver's seat, and turns out if you have one person turning left and one person trying to go straight, you kind of go in the middle, and in the middle is usually not a good business plan. So when I'm partnering with people, they want to front the money, or they want to source some debt, or they find a deal. Cool. We have to sync up on the business plan. And then if I'm doing that deal, I got to be in the driver's seat. I've got a rule. I don't raise money for other people. That's a hard and fast rule for me. I will never raise a dollar for someone else if I'm not a part of it, because I can't control it. And also, if I'm putting money into a deal at all, no one else is controlling it. And that's could be limited mindset, but it's also allowed me to go relatively far, relatively fast. Because when I make mistakes, I have to learn from them. I can't blame it on another person. I have to own it. And if I created an environment where it could have been someone else's fault, I'm always going to think, oh, the learning lesson was I shouldn't have partnered with them. Well, that's never a good learning lesson. You got to learn why the business failed. So yeah, I got one person in the driver's seat for a partner. I also don't partner with people that can afford to bury me. I think that would be unwise. They wake up on the wrong side of the bed that day, and they're having family stress, and some person says, oh, you should just take it to court, bleed them out, and then you'll get the deal. That happens to people. So I don't partner with anybody that can afford to bury me. Like every partner I have is within a couple million of where I am net worth wise. And they're similar or less cash flow wise. And just as a safety precaution.
Makes sense to me. Walter has a question. How do we find partners to get started? How do you sell your value when you're starting?
Well, people aren't going to bet on you. They're probably going to bet against you. What I came to realize years after, because of course, the first time you do a deal, you're just trying to get to the finish line. You don't really know everything you're doing. You can't. And if you think you can, you're lying to yourself. So I didn't know 100% why the person lent me that 12% interest down payment on Quincy until later. I thought it was just because it was a good deal. But what I did find out was true is they were actually betting that I wouldn't be able to. And then I'd sign a deed in lieu and they would just get control of this awesome real estate deal. So they're not going to see value in you. What they're going to see value in is the opportunity. So if you got a great property and you can find a way where they can financially benefit and you can move yourself forward, when you just talk to people in the space, you're going to get to meet with people. And you got a unique situation that I didn't know Julie when I was getting started. So people that know people that own real estate know people that own real estate. So if you find a great opportunity, then you just have to share it at places like this. I mean, you have that leg up that I didn't. What I will say though is your ability to structure a great deal is going to be limited to your understanding of math. That question earlier of $5 million property to $10 million property, what's your return? Most people are going to put down $1.5 to $2 million to buy that deal. Unless you're in the Midwest or somewhere like that, then you're putting 20% down where you cash flow it. They're going to put down $1.5 million to $2 million and try and double the money. So they're trying to turn 2 into 4. If you can figure out how to structure a deal like that with $500,000 and turn that $500,000 into $2.5 million, you're going to get a lot of interest from money because you're getting above market returns on the same deal everyone else is doing just because of the leverage. So I'd rewatch the video and try and get as crystal clear of an understanding of how to manipulate returns based on your leverage point and not just doing super high leverage on every deal because that'd be stupid. You got to do risk adjusted returns. So I would just make sure that you understand how to get a great cash on cash return with the high leverage point over long periods of time. And that's going to be a function of looking at your factor rate, your cap rate, your debt length. Try to do 7 years or longer on all debt terms that you get, if you can. And the money will be very easy if you start structuring your deals like this. Like I just one side segue. I just bought a deal that was on the market for 284 days, and I'm buying it for 430. It was listed for 450. I got the seller to finance 15%. I talked about this briefly earlier, but I bought 10% down. Brought an equity partner for the 10%. So they're putting in 43,000 plus 25,000 in renovation money. I have a buyer lined up for 800,000 net sales price. That's net of excise tax and commissions. Because we're adding a few units in there. Used to be an old converted motel. Owner lived in the units, converted it to traditional apartments, but left all the exterior doors, all the bathrooms, all the kitchens. So they just made one unit that was 2,400 square feet, a couple that were 800, one that was 1,600. So we're just going to convert it into a 9-plex. I mean, it's going to be a sweetheart deal. But because we got such high leverage and made it cash flow on the front end, the fact that we're turning a 5-unit into a 9-unit, our I guess you could say IRR. I don't care about IRR, but the return is so good, turning about $70,000 into 300 and change over the course of 18 months. It's so good that you're going to find someone to fund it because it's almost a 10x equity multiple, and we can achieve it.
Wow.
Realistically, I mean, we could achieve it in the first year, but you tell them 3. And so, like, if you have that good of a return, and you bring it to a group like this, I mean, Julie would probably fund it, or anybody here that has any money at all would fund it, because where are you going to get a 10x equity multiple?
Mhm.
Even if you offered them 6 and you kept 4, right? It's so good. And that deal just sat on the MLS for 284 days. The same with 38 Plex. 38 Plex sat on the market for 13 years straight, and now it's worth double what I paid for it in 4 years. It was a negative cap rate when I bought it. You could pay cash and lose money. But because of the way the debt was structured and the value add proposal, it was really easy to fund.
If somebody wants to get a hold of you, not that you're going to take a bunch of time, somebody had a question, how would they get a hold of you? What would be your best way?
The YouTube's a good way to reach out. I also put my number in the chat.
Nice.
People that hide their phone numbers are funny because it's all on Google.
Yeah. Cody,
But
this
feel
has
free to
been
send a text.
amazing. I mean, just
Appreciate
truly
it.
amazing. 253-389-3005. That's Cody. Do not take advantage of this. Cody's been so gracious to all of us tonight. You guys, I am just so honored that you, the third time, spent an evening with us, just, dropping a lot of nuggets here. So I so appreciate it, Cody, and I hope you'll say yes the next time I ask you, because you are so valuable to this community. We so appreciate it.
I appreciate it. And Paula, that is not a Google voice. But I do have 2 numbers. I've got a 509 number as well. And I took out the Google voice message because it's obnoxious. I learned you can get rid of that. This is a Google voice. State your name. But yeah, I do answer my calls. So
Thank you, Cody. That's really sweet of you. Thank you. Stand up
you
guy.
bet.
Yeah, just an amazing guy. So, hey, congratulations on the wedding coming up. That's super exciting. And I hope to someday get the honor to be with you guys to just give you a hug and a handshake. It's wonderful. Appreciate
We'll
it.
make it happen.
I look forward to it.